Thanks, Tim. Appreciate the intro and the invitation. Go to the next slide, please. So OC Funds Management, if you're not familiar, is a smaller micro-cap fund manager based in Melbourne. We look after over $1.7 billion. And the strategy is really to find high-quality industrial businesses we can understand, generally that have earnings growth and are led by high-quality management teams that we come to know intimately. We have an investment team of 4. As you can see, Rob Frost, Rob Cowan, Steve Evans, and myself. Rob Frost, Rob Cowan, and Steve, they've been working together for a long period of time and have been in markets for close to 20 years or over 20 years. So I've only been in the market for 10 years, so I've still got plenty to learn. Go the next slide, please, Tim. So in terms of micro caps, we define a micro cap as a company with a market cap below 500 mil at purchase. Our benchmark is the Emerging Companies Accumulation Index, and we're seeking to outperform that benchmark by 5% over a rolling 5-year period. Get the next slide, please. And so micro caps are interesting for us because as they're smaller companies, generally at an earlier stage of growth, they generally have greater growth opportunities. And furthermore, as they're a little bit younger, generally that also means the founders are still involved and have a large equity alignment. They still own quite a large amount of equity. This alignment is quite powerful, and we think that self-interest is the best interest, and so generally that can lead to better outcomes. Furthermore, as micro caps are sort of less liquid and smaller, there's generally less attention on them from the market and other analysts. This can generally mean that you can find pretty good opportunities which are undervalued. And for example, some micro caps that have gone on to graduate and grow into the small and mid cap stock space include companies such as Unity. Unity Wireless was actually a micro cap stock that we invested in pre-IPO. And that was a very different business at pre-IPO stage. It was in fact a fixed wireless business that we followed for a while. It didn't really start to perform until Mick Simmons and Vaughan Bowen joined that business and restructured it and embarked upon an acquisition strategy. Furthermore, we invested in a company called Opticom. This is a NBN equivalent sort of business which builds fiber networks into homes, generally broad acre developments and also apartments. And we saw this business at IPO stage, and Steve Evans and I met them and thought it was a cracking business. We bought that in the micro cap fund, and eventually that one grew and re-rated to the point where we bought it for the small cap fund, and then that business came together with Unity. And that company today is a small cap stock in the small cap fund. We actually own that one. It's one of the top 5 stocks. And we think over time that will graduate into the mid cap size market cap. Next slide, please, Tim. And so generally the process has worked out reasonably well over the last 5 years. Markets have been kind to us. However, the Emerging Companies Index has also done quite well, delivering 14% return per annum over that last 5-year period. We've had a pretty solid year and we've delivered 32%. However, the Emerging Companies Index has had a really good year. A lot of that 55% return has been delivered by a few really big lithium stocks that have sort of tripled. And that's been a reasonably strong headwind in terms of relative performance. Having said that, we've stuck to our knitting in terms of buying industrial companies we can understand. We typically eschew biotechs and single commodity, single mine stocks. We generally try and stick to companies that are fairly easy to understand and we think are reasonably lower risk at that sort of micro caps level. Next slide, please, Tim. In terms of the IPO pipeline at the moment, we're really busy looking at IPOs. There's lots of opportunities coming to market at the moment. In terms of the opportunities we're looking at, most of these companies are in fact small cap and sort of $1 billion plus companies. And you might be wondering why there's a picture of a bloke in his undies on this slide. This is actually step one. They produce underpants and they have a direct to customer model, which sells directly to customers, which they find on the internet. and then they supply the products to customers, and they don't actually have retail stores. They don't distribute via Target or Kmart. So we've been doing DD on that business. We think it's actually a very interesting business model. I have tried the undies, and we think that the runway for that business is actually pretty interesting into the US and UK. In terms of small cap stocks, GQG, which we've also been looking at, is a pretty interesting growth story. Rajiv Jain has driven that business and has a 25-year track record across global and emerging markets investing. And so he's managed to build a business which has gone from $0 to $86 billion in FUM in a very short space of time. SiteMinder is another interesting company we've met recently. This one is a hotel software business. So they plug into the property management system for small hotels, and these property management systems are the systems you would actually interact with when you go to sign up or when you go to check into a hotel. And the SiteMinder channel management software actually connects these properties, the property management software of hotels, with online distribution channels such as TripAdvisor and Expedia. So that's also quite a strong little software business. An illustration of this is, revenues last year only declined by 6% for SiteMinder, which was, in the middle of a pandemic. So we think that's quite an interesting little software business. Happy to take more questions on any of these companies later. I'll take the next slide, please, Tim. In terms of the reporting season, we just saw, the issues that we encountered are probably, in the press and understood. Brendan Boyd can definitely talk to these in a lot more detail later. We have met Silk a number of times and have invested in that business and supported them from IPO. Supply chain, inventory build, and labour shortages are all front of mind at the moment. And these sort of lead to inflationary pressures, which a lot of fund managers are thinking about and sort of thinking about the implications of inflation upon rates and what that means for valuations. Over the last few years, interest rates have sort of gone one way, and as they've come down, valuations broadly, particularly for tech stocks and property and infrastructure businesses, have actually re-rated pretty strongly. So when rates go up, we think potentially there is valuation headwinds for some of these longer dated tech stocks. And so having said that, we are pivoting the portfolio slightly towards stocks which are sort of lower valuations, but cyclical and still have some growth. Having said that, it doesn't mean we've sold all our growth stocks and gone to low PE cyclical valuation trades. We do have a broad range of both companies which are growing rapidly and also, companies which are still growing but trade on a reasonable industrial type valuation. Next slide, please. Just to give you an illustration of these companies across the fund, in terms of the micro cap fund, we do invest in, as I said, ARR stocks that trade on a metric of revenue, such as Nitro, which is growing rapidly and not quite profitable. But we do have a spread of companies which are profitable and are growing profits and are trading on sort of normal valuations. Probiotech is a stock which I'll talk about more in the next slide, please. And this one is an industrial business and it trades on 12 times PE. Having said that, it is still a high quality business. These guys actually manufacture cold and flu tablets and analgesics for big multinational pharma businesses, which you would be familiar with, and you would have definitely interacted with some of their products, which might be cold and flu tablets. Imagine brands such as Benadryl. And so they manufacture these tablets in their production facility, which I've been out to in Melbourne, in Laverton. And then these tablets get packed through blister packaging and then sent to distributors. And so this manufacturing process needs to be validated, and the TGA has to validate each step of the process. And so this means that if you were to try and move the contracts, it takes up to 2 years and can be quite expensive to move. And as such, the revenue should be fairly sticky. Go to the next slide, please, Tim. So Probiotech, these facilities, as I mentioned, do require validation, and as such, these contracts can be time-consuming to move. These guys have also won contracts, which means that you will see growth just from the contracts they've won in future years. Furthermore, cold and flu tablets have definitely been challenged over the last year due to social distancing, which has meant that there's been less cold and flu circulating in the community. This should revert over the next few years, which will also help their growth from a lower FY21 base. These guys also do have 3 separate properties up in Sydney they want to consolidate. We think they can generate cost out. So over the medium term, for the next 3 years, we think these guys can actually grow their earnings at teens, and they're also paying a dividend. So you are clipping a dividend yield of 3%, which is unusual for micro caps, plus double-digit earnings growth for 12 times PE. We think that's pretty reasonable. Management, again, highly aligned. Management team do own, management and the family own about 20% of the equity, which is that sort of skin in the game, which we like for micros. Next slide, please, Tim. AI Media is a stock which is more at the technology and growth end. This is, again, a company which has just turned profitable, so it is profitable. To illustrate what they do, I've included a photo I took, and this is of the final, actually one of the final sort of scenes of a Band of Brothers episode, which is a high quality TV series, which I would also recommend. And I took this photo at 3 a.m. in the morning when I was holding a 4-week-old baby that would only sleep when I was holding it. And as such, I was sort of holding her sitting in the couch, watching TV on mute, but reading the captions. And AI Media produce these captions. They have services which actually put the captions together, and then also the technology which encodes the captions into the video stream. So AI Media, they actually disrupt the stenographer kind of market. It was historically done via a stenographer, which was very high quality, but did take a lot, was fairly expensive. And AI Media came up with a technology which actually cut the cost of this materially and has grown through this cheaper technology. Next slide, please, Tim. So while it does have people involved and does have some labor content, so it's not quite AI per se, it does have technology augmented sort of services, in addition to a newer product, which is actually requiring less people and should be higher margin. So this should improve gross margin at a period of time where revenue is still growing 20%. This higher gross profit will generate much greater earnings growth, as fixed costs should be fairly stable. So we think they'll get plus 20% EBITDA growth over the medium term. While it's trading on a valuation of 13 times EBITDA 2 years out, we think that's actually pretty good for quite a strong, sticky earnings profile. Management, again, highly aligned. Founders still involved, owns 13% of the company, so we like that one as well. So final slide, please, Tim. Thanks for the opportunity to have a chat. This is the happy to take any questions across any of the stocks or IPO candidates.
Thanks, Daniel. Good presentation there. Firstly, how do investors access you? I always think investors should have access to fund managers in this space as well as some holdings themselves. How do they access the fund?
Yeah, so here, Tim, you can definitely get in touch with client services at Copia Partners. We also do have you can access us via financial planners, and we're on most of the platforms. Okay.
And can you tell us a little about the IPO market? We believe there's kind of at the ASX, there's a mad rush, given the end of year, there's a mad rush to market. Is that what you're saying?
Yeah, absolutely. Like we're spending plenty of time in processes. As a fund to scale, we definitely get more opportunity to invest in IPOs, and we do get probably an extra 2 or 3 meetings via a cornerstone process. And so before the IPOs actually launch, companies will talk to a few, relatively larger funds that can underwrite their deals. And we're spending a lot of time in these sort of meetings, coming into contact with management teams for IPO candidates, and doing a lot of work trying to understand their businesses.
And how active are you in terms of turnover? We know one small cap manager, for example, has probably taken 100 placements in the last 12 or 18 months. How active are you in terms of your turnover and your time frame in terms of holding an investment?
Typically, a lot of the stocks we do own, we have held a number of stocks for a number of years. Turnover is reasonable for a micro cap and small cap fund. We don't take every placement and trade every placement, but we do take a few and try and ultimately find quality businesses that we want to hold on to, but we do have an event-driven portion of our portfolio as well.
And what happens when you have that success story where it goes from micro cap to small cap to afterpay and size? Do you have to reduce that holding as it grows too large for the mandate?
It can be tricky in micro. So if you do own a micro cap stock which turns into $1 billion company, typically that would be probably a bit too big, and that would actually graduate into small caps. Companies that have done that in the past are, for example, Unity, and that's probably a good example. But eventually, inside the small cap fund, we can own up to 20% inside the ASX 100. But when they go into the 100, it becomes more difficult to own in small cap.
And what do you think of the research in the market in terms of this small cap, micro cap space? Do you rely on broker or external research?
We typically read research. I would say we probably try and find our own kind of sense of our own view in terms of analysis. I try and do plenty of analysis and do talk to brokers. But it is a bit more difficult in the micro cap space. Often if the companies are less liquid, there might often be only one or two brokers.